Hello, this is Vance, and this is Friday, January the 6th, 2017. And these are the CL trades for today using the slow hand method for price action. Now, I've got this chart up here. I wanted to show something kind of interesting. This is a, doesn't matter what it is. Take a look at this particular chart. And if you look at this chart, you see price traded down into this area. You can see an obvious range here, okay, where price is kind of rotated up. Breaks through the top of the range, heads down a little bit lower, and then price breaks this channel, hits a new low, pulls back, attempts to go down again, and right here, you look at taking an entry, okay? Right here. Would you take an entry there? And what would it be? Would you go short off of this bar or long off of this bar? I think the answer is, what would you decide to do? Now, picture this again. We trade down into this range, breaks through a little bit further, and then what? What do you do here? Now, would you go short off of this one or would you go long off of this one? So if you went this bar, would you go short here? So if we look at it from, let's take a look a little bit further back. If we look at this bar, we look at this as a first. Do you think this is a break of the trend channel? Price goes down here, pulls back, moves up, goes down again. Immediate turnaround. Would you go long here? Right on this bar. Okay. That's the question. Would you go long right here when it's closed? If you could put your stop down here. Okay. Now, the reason I'm talking about this is that nothing in trading is 100%. There's no two trades are identical. Each trade is unique. When you put a trade on, you don't know whether or not it's going to go up or it's going to go down. But what we do know, and this is what you should try to, you have to keep in mind, that your rules are rigid. You can put your rules in place at any time. Those are rigid. Your stops are rigid, or should be. But the direction of a trade and which is going to go is you have to be flexible. You have to be open to that. And if you see this kind of pattern, this type of pattern, and you see this, which I would consider this a second entry. Why? First entry, pullback. Is this second entry? Well, these are even, but what it really looks like to me is price attempted to go down to here. First time. Pulls back. Attempts to go down again. Pulls back, okay? First attempt to go lower, fails. Second attempt to go lower, fails, okay? Now, the tenet is that you always look at, this breaks the trend channel, of course, but what you look for is the market failing to do something twice and then just doing the opposite. So would it do it, I don't know if it does it a third time. It could. But the point is that it's attempting to go down, fails, attempts to go down, fails, okay? Now, look at it from up here. Here's the market attempt to go down the first time, failed. Tried to go down the second time, it failed. Tried to go a third time, and it broke up, and then it trapped traders. Now, this didn't kind of adhere. This is 3 times it failed. So, ergo, could this one go up before it fails? I don't know. And what would the target be? Well, if I'm looking at this as the top, resistance right across here, then is there enough room to get up here before it turns back again? I know there's going to be some resistance up here. There must be traders up here someplace. Probably sellers resident up on top here. So would you take that trade long or would you prefer to take this trade short? Okay. Well, if you would take it short, you'd have to wait for another setup for a second entry because price has gone up the first time, fails down to here, go up the second time, so you'd have to wait for at least the next bar, right? Are you prepared to do that? And that is really the question. So you have a failure here. Price couldn't stay down. Tried to go down again. Didn't even get to the bottom of this one. And it didn't stay down. So my thinking was a long. Now, why am I showing this particular bar, this chart? It's because I had a comment of an individual that they couldn't see being able to take a trade down where I took it yesterday. So let me show you this area on a different chart. It's right here. This area that I just finished showing you is this area right here. Okay. The last chart I showed you was a 1200 tick chart. This one is the 800 tick chart. And if you look at this chart, again, I see this as price moving down here. First time, moving down here. Second time. I don't know what that means to you, but to me that looks like two failures. Two attempts for price to go down and failing, and then going in the other direction. Where did I enter? Right at 94, right here. Right here. Price came back. It was limited in on this one. But right at 94. So just above that trade. Now, you saw this on the other chart where price had pulled back, but it's exactly the same time. This is 31. And this area that I'm talking about on the 800 tick chart, this is that area where price failed down, pulls back, and if you see it on this one, it's the same area. Now, is this clear? Now, I don't trade using the 1200 tick chart. I trade using the 800 tick chart. But do you see the similar? Do you see which one is easier for you to enter in? I'm aware of those other time frames. I know what it looks like. Besides, so I can see using math, using the idea that candlestick math, that this is a down bar. This is going to be a down bar. These group of bars are down bars. These are inside bars. Down bar, inside bar, down bar, up bars. This is just one bar going up basically. Down bar, inside bar here, like to this level, and then turns around immediately. Now, I don't know it's going to go up here. I don't know that the trade is going to make that, but is it realistic to have, I got in at 94. Is it realistic to get the first contracts off? Well, enter at 94. It's going to the target is right here. Comes back, and where does it come back to? Comes back to 96. I think it was 95, pardon me. 95. Now my stop is break even plus one. I'm not saying that it just got in under the wire. But was it worth it? Well, look what happened. Price, first entry, second entry. Could you take it go long here? I hope that answers your question. I mean, second entries don't necessarily, just because this particular bar is 5 ticks out, this one is 2 ticks out, really doesn't make a lot of difference. The fact of the matter is that, can you see where the momentum is? Can you see where traders could be? Where are they waiting on the wings? And recognizing that every single trade is unique. They're not going to be identical. I mean, it'll be a similar pattern, but it's not going to be identical. The similarities are going to be like price attempting to go down twice. Now, is this twice? Is this at price attempted to go down twice? Which seems like that to me. Sellers are trying to push price down, but they can't do it because every time they try to get a little lower, buyers step back in and prop it up. Here, again, buyers pull it up to here, and then sellers tried to take it the other way. They couldn't do it, and buyers stepped in again on this very strong bar. So to me, even on this one, you could even use this one as an example. Sellers came by, buyers bought back in. Sellers tried to sell, buyers brought back in. Sellers tried to sell, buyers back. How many times are you going to go through this? Who's going to overwhelm who? What would be the realistic? And considering that we already had this decline based on the report, the news-driven event, did it go too far? I think it probably went too far at this area. As you can see, price was really bouncing here before it went. So I'm thinking we're going to get back to this level anyway. At least, once price gets above this, then what's going to happen? Well, we can see what happened. As soon as price got above this area, it climbed. It kept going, and it actually made an assault on where the start was, the news event. The news drove the price down here, and by the end of the day, it reeled it all the way back up. I mean, but I don't know that's going to happen. I did not know this was going to happen for sure. I think it's a reasonable assumption. I mean, it's a reasonable probability that we're probably going to get at least the first target off, which happened. And you can see that if I had gotten in at 95, I would have gotten taken out. I might not have gotten into here, but I don't know that. I only know what I got in at. That was it. And it was survived by a single tick. That's what I know. So that's in hindsight. Will the same thing happen tomorrow? No, it's going to be a different trade. But at least I was open to that opportunity, and that's why this trade was successful. It's got nothing to do with the count. It's got nothing to do with what was aggressive and what isn't aggressive. Is that, in my mind, this was an aggressive trade. In fact, even though I mark those with, maybe it's a bad use of terms, like saying that this particular trade is aggressive. Every trade I put on, I expect it to go to target. I wouldn't put it on otherwise. So maybe the reason I use the word aggressive is just because there's lots of people out there that just can't see it. Or why would you use that criteria for entering this trade? So to label a trade as aggressive, that's a judgment. That's a judgment. Aggressive to one person could mean very passive to another. What's the opposite of aggressive? It's passive. So if you have a passive trade, is that what it is? It just presents itself? That's never the case. I made the choice to put that trade on. I made a choice to make that to do it, and I wouldn't want it any other way. That's my choice. So I don't know how else I can explain it. I think what most traders should try to do is, and most traders I know attempt to cultivate, is being open to the market, being open to or willing to accept what the market is willing to give you, and not, and I don't like to use the word force trades, but to try to outthink them, to think that your mental ability is going to drive the market, or you can predict exactly what the market is going to do and get upset when the market doesn't do it. Because every trade, there's a problem. There could be an opportunity. There's a chance that the trade will go in a direction that you hadn't planned on. Even if you count a second entry completely perfectly, it still could go in the other direction, because that's the nature of trading. Do you feel comfortable with that? Because if you anticipate, all we can do is anticipate the direction of a trade based on our experience. But every trade is unique. I look at it from what helps me to look at it is seeing the market as trying to do something twice and then doing the opposite. That's the whole basis for second entries. That's the basis for almost all my trading. Thinking the trade are going to happen. I try to frame it in that respect. Very simple. Yes or no. Risk on, risk off. That's how I structure it. Now, should everybody do the same thing? No, but if you also have to remember that you have to doing this at a very fast pace, because you have to be able to execute. That's the way I arrange it, so that I can execute quickly. See, take a look at this trade, to sum it up, to measure it up, to get ready to go in, probably takes a very short period of time. And I've already explained this for 13 minutes, and I set up the chart to try to explain it better. So this trade took probably less than a minute to figure out. And yet I've been explaining, I could probably go on for another 20 minutes explaining why I took the trade at the time I took the trade. It takes way longer to explain it. Now, if I explain this trade this way, the next trade tomorrow will be, I might use the same criteria, but it's going to be a completely different trade. They're not going to paint it, because it's going to be different person selling that contract, different person buying that contract. It's a different day, different time of day, different news. It's not going to look the same. It's going to be different. And so I'm just trying to look at recognizable patterns. When I see this pattern, when I see trading coming down to it's got to turn around at some point in time. And if I look at this as exhaustion, because if I see this has been the news-driven event and the prices came down to here, and if this took a minute to go down here, then that's a little bit different than this took 30 minutes to go down here, to my mind, and starts to slowly build here. I think that there's buyers stepping into the market, and it's more realistic for me to look for a long than a short. But that's not to say that the buyers just get overwhelmed and price can head in the other direction. It didn't happen in this case. It kind of happened here. Buyers were kind of like, buyers and sellers were going back and forth, and it broke through the top of the channel and then failed immediately. It looked like it was trying to do that same thing right here. Broke through the top of the channel, but it didn't fail. Prices went down the first time, failed. Second time attempted to fail, and then sprung right out of here. Could have purchased at this level as well. There's a unique aspect to every single trade. Every trade is different. Now, I've taken a long time to explain this. I hope you can get the sense of it. If you have any questions, please let me know. But, I just wanted to explain this one area and to explain why I took this trade. And hopefully you have a greater understanding of it. If you have any questions, please get in touch with me. slowhandmethod@gmail.com. This is Vance. Bye for now.